We have breaking news right now. The European Central Bank announcing it is leaving interest rates unchanged, as we expected. Joining me right now is the chairman of UBS, the former president of the German Bundesbank for some 7 years, Dr. Axel Weber. Great to see you, Axel. Thank you so much for being here.
Thanks for having me.
Are you surprised to hear that Mario Draghi and company are leaving rates unchanged in Europe?
Everything else would have been a surprise. So they've announced that they will keep rates on hold till well into the summer, and this is what they reconfirmed. So no really news.
As a former central banker yourself, though, Axel, I mean, do you worry that the central banks don't have a lot of wiggle room? I mean, let's face it, if we get a sharp downturn, like some people are expecting, there's no wiggle room to cut rates because they're already at zero.
That's right. And I'm actually more concerned that it's not just central banks. In Europe, for example, rates are still in negative. It's also fiscal policy. So if you look at France, deficit estimated by the IMF last time around was 2.7% negative. The only country that has a surplus is Germany. So not just monetary policy has very little room to react, even fiscal policy, which are the two main stabilization tools in a downturn, have very little room to react without immediately getting outside the Maastricht criteria. And so it's Italy, it's France, it's many countries around Europe that have no room to react in fiscal policy, and the ECB has little or very few things that they can add in addition to just re-entering the old policies. So I think in terms of normalizing policy, it's probably not going to be mission accomplished, but more likely mission aborted this time around. The Fed's on hold. The ECB probably will not, in a softer economic environment, which we're seeing ahead, raise rates, and it's reasonable not to do that, but they missed the opportunity to normalize when times were better, and so that's really going to postpone policy normalization into the next cycle, rather than seeing it on this, pretty long recovery period already now.
So what's your expectation? What happens then? Mario Draghi just said a moment ago, these rates are going to be here likely until the summertime, as you just stated, basically. But what's to come? I mean, are we going to see a sharp slowdown across the globe?
No, I think we are seeing a soft spot in the global economy. And if you look at the major markets that are affected, we've just revised down our growth forecast for most of the European countries, around 0.5% on average, and for emerging markets by 0.5% as well. So what you're seeing is a slowdown that, by and large, the majority of that slowdown comes from external factors. So it reflects some of the uncertainty and tensions around trade. We don't expect a recession. So we expect a soft spot. The economy will improve towards the second half of the year. So monetary policy is on hold. We still expect the ECB to start looking at rates at the end of the year. And if the economic data improve during the summer, they're likely to start moving out of negative territory, in December, at the in the late part of the year.
Yeah.
So negative rates are going to stay longer than Mario Draghi.
Wow, okay. And then there's Britain. The British Parliament now getting closer to a plan that could delay the UK's exit from the European Union. British Prime Minister Theresa May says that a delay is not the answer. What's your sense of the Brexit situation?
Well, delay is not the answer, but it might be tactically a good way to get negotiations to the finishing line, because at the moment, everyone is so all over the place. There is no majority for any one solution, and I think simply because the time is ticking, it can't be the solution since you don't find an agreement that there's no solution and there's a hard Brexit. A hard Brexit, we're prepared for it. I mean, we always said as banks, we prepare for the worst, which is a hard Brexit, and we hope for the better. But it's not a solution politically to really do a hard Brexit, because the impact of that on the British economy, the spill back to the European economy, and the spillover into the global economy, all of these three things are really not very good. And that's not what the global economy needs at this point in time, where it's already cooling, where there is already some slowdown. Adding a hard Brexit with no system to go to is really going to be another tail risk materializing, and that's not what we need.
Does she really not know what kind of trade deals she could get with other European countries, because all of those countries are represented by the EU?
And I think, a customs union where you have a common set of tariffs is not such a bad arrangement. I mean, you really have to ask yourself, does national sovereignty boil down to being able to choose a tariff that is independent of the tariff of other countries? We've harmonized products and product markets so much, we've created cross-border transactions. So I think we should try and move to a world where tariffs are starting to disappear and there's more free trade, rather than looking at customs unions where we start building walls around our countries with tariffs that would undermine trade rather than enhance trade. So I think directionally they're really traveling in the wrong direction here.
Well, let me switch gears and ask you about the markets a bit. Obviously, a tough fourth quarter for everybody. Markets were very volatile. You saw outflows in terms of wealth management. What's the sentiment today? What kind of a 19 are you expecting in that regard?
So I saw some of our clients from the Middle East. They tell me their accounting year is from March to March. They're already seeing in their last quarter some rebound from the December. And I think that's where we are. You really saw that the market was quite in an agitated mode already in November, but then December was one of the worst months, actually since post-war history. And so we've had a really bad December, and it was largely driven by fear factors, by geopolitical risks. The market has since then started to come back somewhat. And some of the big fears, name one, there was a concern that the Fed would go too far, too fast. That has really been taken off the table. The market has largely priced out any further rate moves by the Fed this year. I think they got a bit ahead of themselves on that. But the Fed is clearly, in my view, on a pause till mid-year. They will reassess data. And I think it's not unlikely that they'll touch rates again, but I don't have that down as a early event in this year. It's going to happen if it happens towards the end of the year. And the Fed will only do it if we see better data. So the market should take reassurance if the Fed resumes hiking towards the end of the year, because that means they saw data come in that warrant confidence of the Fed in the economy. If the Fed abandons rate hikes and is on hold for long, that shows you that the data that are coming in are weak. So I think, they will be very data dependent, and Jay Powell is really playing it, along the data line, and he's made very clear, I don't have a preset course, which was what really concerned the market. They're really reassured since he said, I will take my time. There is no inflation pressure down the road. There is no real challenges that he faces in order to meet his dual mandate. Employment is doing great. Inflation isn't back.
They made a mistake doing a fourth hike in December, by the way.
I think, what he did was actually the data that were coming in at the point in time were still strong. And, you also have to, you talk about room to maneuver. They were wanting to normalize. And low rates, way below normal, do have impact on other financial markets. They don't add to financial stability because it drives cheap liquidity into a lot of investments, even including investments that might not be long-run profitable. So I think he's trying to undo some of these distortions that low interest rate policy causes, but he's doing it at a reasonable speed. And just now he's taking a pause, looking at the data and reevaluating his stance.
By the way, before we go, we've been talking a lot about the negatives surrounding China, whether it be espionage or IP theft or an unwillingness to open the market. You're one of the few companies, UBS, to be allowed to own 51% of a bank in China.
Yes, and so
we got that in December.
We got that, and we basically closed that deal in December. We have a 51% majority stake in our former JV. We're still in the same JV. We have partners in the municipalities of Beijing and Shanghai. So it's been a positive development for us.